All right. Check, check, radio check. So we'll get started. This week's topic, is emotions and investing and I'm just gonna share, some of my experiences and observations over time. And then this call typically takes about 15 minutes, 20 minutes if you haven't been on before, max 30 minutes depending on the subject matter and topic. And I just feel that this is important because we are not robots, although we hear a lot about in the news today with AI. And there's some cool technology out there. But when it comes to human beings and investing, this is we think we can react in time, but a lot of studies have shown that if we're not careful, we can get caught on the wrong side of the equation. So this is just showing a chart of the S&P, and the reason that I wanted to start with this is, over time, I mean, since the Great Depression, right, and since the inception of the S&P, just take a macro look, and you will see that, you know, over time, things tend to move upwards from the left to the right. So even with Corona and the recent Corona, and then we had the 2008 financial crisis, and the dot-com bubble burst, all these things that happened in our lifetime. It's still the markets will continue to perform, and that's where people are trying to create wealth, have money for the future. And so I point that out because the next slide, we'll start to talk about a cycle of emotions. And, as we go through this, typically, we'll start with optimism, right? Where like things are great. We're gonna come out of this. Hey, I heard about this investment. Let's just take Bitcoin, right? That's in the news all-time highs, right? But last year it got crushed. Well, as things continue to go up, woo, yes, we're planning our early retirement. Everything's good. All the stars are aligned and we get to that point of euphoria, like nothing can go wrong. And I first experienced this firsthand when I saw during the dot-com bubble burst. I would meet with folks and they were absolutely convinced that their AOL stock, they were retiring at 45, that everything was fine. And then a downward trend started to happen. Then no, it's denial, and then anxiety, fear starts to creep in right about here. What do we do? Depression. Oh my God, it should have gotten out. We're talking to ourselves. Panic, right? We've just lost everything we made. And capitulation is one of those words that it's basically just surrender, right? I don't want to look at anything. I don't want to open up my 401k statement. I don't want to have anything to do with investment. I can't handle it. And then it's despondency, which is akin to depression. Now I'm going to talk about something called the wall of worry, right? And this is where we start to come back up, right? We start to say, hey, skepticism. Well, maybe things are going to get better. Hope, relief, and now we're back to optimism, right? So we're back to the cycle. And what I wanted to point out is that, right now, a lot of people, are excited about the markets. The markets, all when I say the markets, I mean the S&P, the Russell, the NASDAQ, the Dow have shrugged off last year and have hit all-time highs, a lot of them, right? And as we start to look out into the future, I hear a lot of euphoria. I hear a lot of, hey, everything's fine. Even, most of the, bad news is like it's shrugged off. Where I start to sort of parrot some language that I've heard. It's be careful when good news can be perceived as bad news or by the markets. And so, now that we're hitting all-time highs, I don't think the recession is happening in the next 1 to 3 months. I don't have a crystal ball. I said last year, I was one of those people that sat in the beginning of the year and said, hey, be careful. But I do think because we are so news oriented as a society and the markets react, you have that coupled with, it being an election year. You have a lot of, just some pretty crazy things going on from a society standpoint, right? I won't get into all the negativity. I want to keep this call upbeat, but any of those things can cause some of this stuff to derail, which is, if it starts to get down, now we get to a point, and this is when we should be entering the markets, right? So if you're in now, things are good. I think it will continue to go up to the right, but we can't time the market. We have to be consistent, but you also can't react. You can't wait until after the damage is done. And I used to say during 2008, right? You don't want to try and catch a falling knife, right? So if a knife is falling, you were sitting there and it dropped out of your hand, and you go and reach and grab it, you're going to get cut. Sometimes you gotta, just not be in the markets, right? Or to start to, at a bare minimum, rebalance your portfolios, right? So turn around and start to think about, hey, if your risk tolerance showed a 60-40 balance, then make sure that you aren't overweighted in equities. And that would be the area of adjustment that I would start to offer some guidance, right? Again, I'm not giving investment advice on this call. I'm just saying get with your financial advisor. If you're overweighted into equities right now, start to think that, where are opportunities on a forward going basis? And if we're at all-time highs, not that we can't go higher, but bonds start to look a little bit attractive, because if the Fed starts to lower interest rates, right, in an ease, to try and ease inflation, right? If they, we're in a conundrum, right? So I won't get into some of the technical stuff, but if that happens, bonds, right, it's an inverse relationship. Portfolios of bonds could actually increase. So for an intermediate play, it may be something that's attractive. So here's something I found interesting. So just behavioral sciences, right? So behavioral finance. If you offer somebody a choice of a sure thing, $50, or on the flip of a coin, the possibility of winning $100 or winning nothing, chances are that person will pocket the sure thing, right? And I tend to probably say, hey, if you're going to give me $50 for no risk, I'm taking that. But if we conversely offer the choice of a sure loss of $50, or two, on a flip of a coin, either lose 100 or nothing, the person, rather than accept the $50 loss, will probably pick the second option in the flip of the coin. This is known as loss aversion. And we all have this inherently ingrained to different degrees, right? So it's just, the chance of a coin landing on one side or the other is equivalent to in any scenario. Yet people will go to the coin toss to save themselves from the $50 loss, even though the coin flip would mean even a greater loss of $100. And that's because people tend to view the possibility of recouping a loss as more important than the possibility of a greater gain. So, again, we are not robots. And as much as people would, AI and robo investing, and there's an element of every person is unique, and we have to look at this and saying, what is your risk tolerance? And if you're married, right, your risk tolerance may be different than your spouse's. And that's why having sort of a game plan, a strategy to look into, say, hey, plan with the end in mind. You will hear us say that at professional planning services all the time. Plan with the end in mind. Show us where you're trying to get to, and we'll help develop a plan or a strategy to help you to get there. So consumer sentiment. This is typically, it's a contrarian indicator, and it's been up since November of last year, 29 points. The consumer right now is actually, very bullish into the marketplace. They have not slowed down on their spending, and then we actually have higher household net worths than we've had in a long time. So that sort of is because it's a contrarian indicator, and what that basically means is that people are generally wrong. So if people are starting to feel more comfortable about the markets, that's where, you could take the approach and saying, hey, you know what, maybe I want to play the other side of the equation. So all I'm saying is give your portfolio some attention. It's okay to rebalance in a thoughtful way. Just don't be reactionary, right? You don't want to turn around and sell at the wrong time. It's that old adage, you want to buy low, as that initial chart showed, and sell high, right? And be, you're going to see on my next slide, this is what the headlines talk about. They only really have two things, and this is how they generate revenue and they acquire advertisers, right? If they can scare you, right, then you panic and you either do nothing, the sky is falling, chicken little, or greed like Bitcoin, right? All the rave, everybody's talking about it at cocktail parties and holiday parties and family gatherings. Yet at the end of the day, when it falls south, it's almost like the person that goes to the casino, right? They go to the casino, they will always tell you every time they want, oh, I went to the casino, I killed it. But they'll never tell you when they lost. So, it's, this is our retirement we're talking about. This is investment. This is our money, right? And the people on the news media and the periodicals and the talking heads, they have a function, and that is to get ratings. But when it comes to you personally, they don't know your circumstances. And so you really have to, if you're doing this yourself, you should be thoughtful. And it's hard because this is your money. And if you get up to 65, right, 67, 68, and you say, that's it, I'm done working. Do you have enough money to last for the next 10, 20, 30 years? Right? That's like being on unemployment for 30 years. You make a wrong choice when you're 60 and you could be working till you're 80. So, you have to, I think that, people get wrapped around the axle with, oh, well, I can get low cost fees from, some retail platform. Yeah, you get what you pay for. But, what I've heard time and time again in my experience is that they really, even though they might call it a wealth management section, they don't have that person that really knows you by their first name, knows your kids' names, knows what's going on with you personally and where you're trying to get to. And so again, this is my pitch towards, professional planning services. We will help you to sort of to curb the emotions and have a plan, have a strategy. And then lastly, my bare minimum advice is be consistent whatever you do. And this is why I actually do like 401ks. I just had a gentleman call me yesterday and says, hey, can I just send you $500 a month? Yes, we can auto draft it, right? Just do something regularly, right? We can't time the market, I think, successfully. At least in not in my career have I ever seen anybody that's been able to do that. Yes, you could throw a dart at the dartboard, and as I used to say, you could open up when you were looking at stocks in the newspaper and before, and you said, "Hey, what's a successful stock?" You could throw that dart and hit and probably pick a successful stock. That was pre 2000, right? But when people lose 50 or 60% of their portfolio, when you're 40, maybe you could weather that storm. But when you're 50 and 60, you don't have the time to recover from a catastrophic event, a correction in the market. So that was our topic today. We're going to get on to our slides. I do want to say that we will be doing, we're working on, we're going to be at Rutgers doing a Social Security seminar. We'll be sending out mailings and emails and stuff. That's going to be, I think, it's April 20th and April 27th. So we've decided to do them on 2 Saturdays just to talk to people about Social Security because it is a component of our overall retirement plan and should be taken into consideration. So without further ado, thank everybody for being on the call today. Hope you find this interesting and informative. If you got any questions, please reach out and have a great day.